Okay, so how does a global giant, the kind of company that literally helps feed the world, how do they navigate really challenging economic waters? A sudden downturn.
It's a huge question, right? It's not just about tightening the belt. It's about making these big strategic adjustments when things shift so fast.
Exactly. Welcome to the deep dive. Today, we're taking a close look at the latest financial performance of an absolute icon in agriculture and heavy equipment, John Deere.
Hmm.
Our sources for this deep dive are their brand new third quarter 2025 earnings report just released, plus all the detailed financials and, importantly, their outlooks.
Yeah, hot off the press.
Oh,
And there's a
wow.
lot in there to unpack.
For sure. Our mission today is really to cut through those numbers, figure out what's really driving performance in the different parts of their business.
And understand their strategy, right? How they're
Mhm.
responding now and planning for what's next.
Precisely. So by the end of this, you'll have a solid grasp, a really thorough understanding of what's actually happening behind that green and yellow curtain. Let's get into it.
It's fascinating, seeing how a company of this sheer scale pivots. It's like turning a huge ship in choppy seas. This report isn't just numbers, it's a glimpse into how they handle pressure.
Absolutely. And the headline. It's pretty stark. Deere's profits took a major tumble this quarter.
Yeah, they did.
Net income reported was $1.289 billion for the third quarter ending late July.
Which sounds like a lot, but context is key here.
Exactly. Compared to last year, that's a 26% drop, down from $1.734 billion. That's significant.
It really is. And if you look at the bigger picture, the first 9 months of their fiscal year, the drop is even steeper.
Oh, steep.
Net income was down 32% compared to the same period last year. So this isn't just one bad quarter. It's a sustained pressure they're dealing with.
Wow, okay. And I assume sales figures reflect that too.
They do. Worldwide net sales and revenues
Right.
down 9% for the quarter, just over $12 billion,
Then for the 9 months.
down 18%. So yeah, sales are definitely reflecting that broader slowdown.
So the big question is, what's driving all this?
Yeah.
And maybe more importantly, how's leadership? How's the CEO framing it?
Right. Well, the CEO, John May, he acknowledges it. He talks about their disciplined execution, still yielding solid results, but, and this is the key phrase, in the face of a challenging environment.
Okay, so acknowledging the headwinds.
Definitely. And he points directly to customer caution. Farmers, construction firms, they're just being really careful right now because of all the uncertainty out there, holding back on those big purchases.
Makes sense. Is he just observing this or outlining actions?
Oh, actions too. He specifically highlighted their proactive moves, managing inventory very carefully, and crucially, matching production levels directly to retail demand, what people are actually buying.
That sounds simple, but for a company like Deere, that must be incredibly complex, right? Adjusting production lines that quickly.
Oh, absolutely. It's a massive operational challenge. And he also mentioned tackling the high levels of used equipment out there, like trying to build a healthier market for everyone, he called it.
Interesting. So not just focus on selling new stuff, but on the whole ecosystem.
Exactly. It's a longer-term view for market stability, which benefits them, their dealers, and ultimately the customers too.
Okay, but amidst all this caution and adjustment, is there any optimism, any forward look?
Yes, definitely. And this is where it gets interesting. May emphasized that despite the near-term issues, their confidence is reinforced by their technology.
Ah, the precision ag stuff.
Precisely. Things like see and spray and harvest settings automation. He's saying these aren't just features. They're genuinely helping customers improve productivity, become more efficient. And that, he believes, is the engine for future growth, even now.
So betting on innovation to pull them through the downturn.
That seems to be the core message. Even as they had to, refine their outlook for the full year, they narrow the net income guidance to a range between $4.75 billion and $5.25 billion. Still a lot of money, but lower than previously hoped.
Okay, that gives us the big picture. Challenging environment, strategic adjustments, but a long-term bet on tech.
Yep. But like you said, the overall numbers only tell part of the story. To really get it, we need to break it down by segment.
Right, because the performance wasn't uniform across the board, was it?
Not at all. It's quite a mixed bag, actually. If we start with production and precision agriculture PPA, this is the big stuff, right? Large tractors, combines.
It's the core of their farming business, really.
Exactly. And this segment saw the biggest hit, net sales, down 16%, operating profit. It cratered, down 50%.
50%. Wow. Okay, what happened there?
Well, the report points mainly to lower shipment volumes, just selling fewer big machines, and also unfavorable price realization. So fewer units, maybe lower margins on them too.
Any offsets? Did they manage costs well?
They did manage some positive contribution from lower production costs, which helped a bit. The waterfall chart they provide shows that volume mix was this massive negative drag, but production costs gave back a little bit. Still, not nearly enough to offset that volume drop.
Okay, so PPA took a major hit. What about small agriculture and turf, SAT? This is the smaller tractors, lawn equipment, that kind of thing.
Yeah, exactly. And here, the story's quite different. Much more resilient.
How resilient.
Net sales were only down 1%, just 1%, and
Yeah.
operating profit dipped only 2%. So basically held its ground, especially compared to PPA.
That's a stark contrast. Why the difference? Is it just less cyclical?
Partly, yeah. But also, while they did see lower shipment volumes here too, it was largely offset by favorable currency effects
Hmm.
and, interestingly, better price realization compared to PPA.
Okay.
And on the profit side, things like higher tariffs did hurt, but that was almost balanced out by lower warranty costs and, again, lower production costs, especially materials getting cheaper. It's just a different market dynamic.
Got it. Okay, next up. Construction and forestry, CNF, excavators, bulldozers, forestry machines. How did they fare?
Not great, unfortunately. More like PPA in terms of profit pressure. Net sales decreased 5%, which isn't too bad.
But the profit.
Yeah, operating profit down a steep 47%, almost cut in half. Again, the operating margin really squeezed there.
And the drivers for CNS decline, similar to PPA.
Similar, but slightly different emphasis. The report highlights unfavorable price realization as a big factor, alongside higher production costs, again mentioning tariffs. Interestingly, they did have a positive impact from volume mix here, suggesting maybe they sold more of their higher margin construction gear, but it just wasn't enough.
So price pressure and costs were the main culprits there.
Seems like it, yeah. Price was a huge negative on their waterfall chart for CNF.
Okay, one segment left. Financial services, FS. This is Deere, financing the equipment purchases, right? How did they do?
The bright spot. FS actually had a really strong quarter. Net income increased 34%.
Increased. Wow. In this environment, how?
Primarily driven by a lower provision for credit losses, meaning they expect fewer defaults than perhaps anticipated, and also comparing against some prior year special items that made last year look worse.
So less money set aside for potential bad loans?
Exactly. This segment often acts as a kind of stabilizer for Deere. When equipment sales slow, the financing arm can still perform well, especially if credit quality holds up.
Okay, so a really varied picture across the business segments. PPA and CNF hit hard, SAT holding steady, and FS actually growing.
Precisely. It really highlights the different pressures in different markets. Large farm equipment versus smaller stuff versus construction.
So knowing all that, what does Deere see ahead for the rest of fiscal 2025? What's their forecast?
Well, they've updated their outlook for each segment. For PPA, they're now expecting sales to be down between 15% and 20% for the full year.
Still projecting a significant decline there.
Yes. For small ag and turf, they see sales down around 10%.
Okay, a bit softer than PPA, but still down.
Right. And for construction and forestry, sales expected down 10% to 15%.
So declines pretty much across the board on the equipment side.
Yes, though they do expect financial services to bring in a solid net income of around $770 million for the year.
Okay, and what about the broader industry outlook?
Yeah.
Geographically?
Yeah, they provide that too. It's quite telling. In the U.S. and Canada, their biggest market, large ag equipment sales, expected to be down around 30%.
30%? Ouch.
Yeah. Small ag and turf down about 10%, construction equipment also down about 10%, with compact construction maybe flat to down 5%. So pretty significant downturn expected in North America.
What about other regions? Any bright spots?
Europe looks flat to down 5%. South America, for tractors and combines specifically, they see as flat.
Flat's better than down, I guess.
It is. And Asia is actually the one region where they see potential growth, flat to up 5%.
Yeah.
Global forestry, flat to down 5%. And global road building, flat.
So Asia is a relative positive, South America holding steady, but North America and maybe Europe seeing the bigger challenges. That global diversification must help cushion the blow somewhat.
Absolutely. And, connecting this back to the strategy, John May reiterated that commitment to solutions and laying groundwork for future growth, especially with that advanced tech, reinforcing confidence despite these pretty gloomy near-term forecasts. They're clearly focused on weathering this and coming out stronger.
Right, playing that long game. Now, you mentioned special items earlier affecting the financial services comparison. Reports like these often have these kinds of one-offs, right? Things that aren't part of the day-to-day operations but affect the bottom line.
Exactly. And it's important to understand them to get a clearer view of the underlying performance. For instance, Deere actually made some acquisitions in 2025.
Oh, even with things slowing down.
Yeah, spent about $89 million on acquiring businesses. The report says these were mainly to advance their existing tech offerings, tools for profitability, efficiency, sustainability. So strategic buys assigned to PPA and CNF, showing that investment in the future tech continues.
Okay, interesting. What else falls under these special items?
Well, on the other side of the ledger, they took a $61 million pre-tax non-cash charge in Q3. It was an impairment charge related to some overseas battery operations.
An impairment, like a write-down.
Essentially, yes. They determined that the value of certain assets, like a trade name and customer relationships tied to those battery operations, wasn't what they thought it would be, mainly due to slowing external demand for batteries. So an accounting adjustment reflecting market reality.
Got it. Any tax things, those often pop up.
Yep, there were some favorable discrete tax items back in Q1, things like recognizing benefits from foreign net operating losses. Not core operations, but they did provide a boost to net income earlier in the year.
Okay. And I think you mentioned something about Brazil earlier, too.
Ah, yes. The Banco John Deere SA consolidation. Basically, they made a deal with a big Brazilian bank, Bradesco, for Bradesco to become a 50% owner of Deere's financing arm in Brazil.
Way do that.
The stated goal was to reduce the company's incremental risk as it continues to grow in the Brazilian market. So, sharing the risk in what can be a volatile, though important, market. There were some related financial impacts in prior quarters, but the deal itself didn't result in a major gain or loss upon completion. It was more a strategic de-risking move.
Makes sense. One more thing, sometimes companies have restructuring costs, anything like that.
Yes, back in Q3 of last year, 2024, they had costs related to employee separation programs, basically buyouts or early retirements for salaried staff in several regions
Why?
to meet strategic priorities, reduce overlap, streamline things. Classic move when looking to improve efficiency. Cost about $120 million back then, spread across the segments. It's a one-off cost aimed at setting a leaner foundation.
Okay, so understanding the special items, the acquisitions, the impairment, the tax benefits, the Brazil deal, separation costs, definitely helps filter out the noise and see the core trends.
Absolutely. It gives you that clearer picture.
So let's try and wrap this up. Bringing it all together, what are the really crucial takeaways from this deep dive into Deere's Q3?
Well, first, it's undeniable, right? They're operating in a seriously challenging market. Sales and net income are down significantly. That's clear.
Yeah, the numbers don't lie there. But takeaway two.
They're not just sitting back. They are actively, strategically managing inventory and production to match that weaker demand. Trying to keep the market healthy, not just flood it. That's proactive management.
Good point. And third.
Performance was really uneven across the business. PPA and CNF, the big iron segments, took substantial hits. But small ag and turf showed resilience, and financial services was actually a strong positive contributor. Those internal shock absorbers are working.
Right. And the final key takeaway.
Despite all these headwinds, the focus remains squarely on the long term, particularly on advanced technology, the See and Spray, the automation. CEO John May made that very clear. They see innovation as the path forward.
So for you listening, this deep dive hopefully gives you a sense of how a huge industrial company like Deere adapts. It's not just about the headline numbers. It's about strategy, segment performance, managing costs, investing in the future, all happening simultaneously.
Yeah, it's a real-world case study in navigating major economic shifts and uncertainty. Lots of moving parts.
Definitely. Okay, so here's a final thought for you to chew on. We heard about the global outlook, the segment differences, the focus on current tech like See and Spray. But looking beyond that, maybe a few years out, what unexpected innovations or perhaps even totally new business models do you think a company like John Deere might need to prioritize to really navigate what's coming and stay ahead in this increasingly complex and challenging environment? What's the next big thing for them?